Post-incorporation 9 months, they are in the ratio of 3:9, that is 1:3. This is your time ratio. Pre-incorporation is called capital profit. Whatever the profit earned in the post-incorporation is called revenue profit. MYSURU Limited was incorporated on 1st August 2020 to take over the business of Tetra Limited from 1st April 2020. Hello my dear student, I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. Today, this session, I am going to hand Corporate Accounting 1, 3rd semester, Unit 2, Session 5 in favor of BCom, Profit prior to incorporation and post-incorporation. In the last session, I also told, I repeated so many, whatever the profit earned before incorporation, that means before the registration is called pre-incorporation period. From the registration period to end of the year is called post-incorporation period. Whatever the profit earned up to registration is called pre-incorporation profit. Whatever the profit earned from registration, incorporation stage, incorporation, from incorporation to year ending is called post-incorporation. That profit is called post-incorporation profit. So post-incorporation profit called as revenue profit, whereas pre-incorporation is called capital profit. So while you are doing the problem, we require two items. One is called the time ratio, one is called the sales ratio. Which are the two items are? One is time ratio, another is sales ratio. So from the beginning date to incorporation stage, one stage. From incorporation to year ending, another stage. The date you have to mention, you must be very careful. It may be calendar year, January to December, or it may be financial year, April to March. Then we want to sales ratio from the beginning to incorporation, one sale. From incorporation period to year ending, another sale. What is pre-incorporation? Another post-incorporation. So you have to divide all the expenditure into income according to the sales ratio, according to time ratio. We'll move on. Bandhan Private Limited was formed to take over existing business of Aptamitra Private Limited as from 1st April started, but the new company was incorporated. This is started on which date? So April to March, 1st April 2022, 31/3/2021 is 1 year. So this is called financial year. Start from which date? 1/4/2022, 31/3/2021. So incorporated on which date? July. The following is the were extracted from the books as on 31st March 2020, year ending. This is your beginning. Okay, we'll move. So these are the items. Only expenditure income will be bifurcated. So opening stock is given, purchase is given, carriage outward based on sale, sales commission based on sale, salary based on time ratio, administration expense based on time ratio, rent and rate based on time ratio, director fees post incorporation, fixed asset won't come, current assets won't come, preliminary expenses post incorporation, sales during the year they have given to find out the gross profit. This is a capital, it won't come, current liability won't come because only incomes and expenses. Closing stock on 31st December 55,000 is given. The monthly sales in April 2020, February and March, these are the 3 months, or double the average of monthly sales for remaining months of the year. The purchase consideration was agreed to be satisfied by the issue of 30,000 equity share of 10 each. Preliminary expense to be written off, removed. Depreciate shall be provided at 15% per annum on fixed asset. You are required to prepare a statement of showing the pre-profit before incorporation and after incorporation. It started with April and incorporated on 1st July. Here, there is no gross profit is there. So, sales minus cost of goods sold sales minus cost of goods sold is equal to gross profit. This is your formula. What is the formula? Sales minus cost of goods sold is equal to gross profit. Here, as per the problem, the sale is 4,50,000. There is no cost of goods sold. You have to calculate. What is the formula? Cost of goods sold now? Opening stock plus purchase minus closing stock. What's the cost of goods sold? Opening stock plus purchase minus closing stock. Your opening stock is 50,000. As per the problem, see that. What's your opening stock? 50,000. How much purchases? 2,80,000. What's your closing stock? 55,000. So deduct 2,75,000 is the cost of goods sold. From this figure, deduct this. Your gross profit is 1,75,000. Gross profit based on sale. Then, regarding the what's called the time ratio. So, your date of purchase is 1/4/2020. Date of incorporation is 1/7/2020. So, April, May, June, 3 months. From this day to this day is 3 months. From 1/7/2020 to 31/3/2021 is post-incorporation. How many months? 9 months. That is July, August, September, October, November, December, January, February, March. Totally 9 months. So post-incorporation is 3 months. Post-incorporation 9 months. They are in the ratio of 3:9. That is 1:3. This is your time ratio. Hope you understand. It was started on 1/4/2020. Date of incorporation on 1/7/2000 registration. Date of incorporation. It was registered April, May, June. How many months? 3 months. From 1/7/2020 to 31. How many months? 9 months. 3:9. 1:3. This is the time ratio. Regarding the sale. See that? What's the question you asked? The monthly sale in April 2020, February, April, February, March are double the average. So if you have got 1 rupee in other month, here in April 2 rupees, February 2 rupees, March 2 rupees. Double. If you have got 2, 4 rupees. Okay, understand? So from which date? April, May, June, July, up to March. Calculation of sales ratio. Let the average monthly sales be X. Assume that it's a X. Then, now the sales for the different months can be projected. So, from which date? April to March. April double, he says. April 2X, May 1X, June 1X, July 1, August 1, September 1, October 1, November 1, December 1, January 1, February, he says double. February 2, March 2. So, your sales from 1/4 to 1/7 now. 1/4 to 1, how many months? 3 months. So, 2, 1, 1. How many months? 4 months. This is pre-incorporation. From this period, totally 15 no? 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 14. Totally 15. So, first 4, see that? First 4 months sale is pre-incorporation. Next 11 months is post-incorporation. So they are in the ratio of 4:11. What is that is? Sales. So understand, let the sales be X. It is double in April, double in February, double in March. So 2x in April, February 2x, March 2x. Other things are 1 1. So your registration period is 1 7. So April, May, June 4x. From here 11x. So 4x is to 11x is nothing but 4 is to 11. Now we'll move on. Gross profit 1,75,000 as per working note. It based on sales ratio 4 is to 11. 4 by 11 is 46,667. 11 by 15 is 1,28,333. This is your A. This is revenue profit. Now expenses. Your expenses carriage outwards based on sales ratio 5,000, 1,333, 3,667. Then sales commission, sales ratio 8,000. If we divide pre-incorporation 2,133, 5,867. Regarding the salary, time ratio 1 is to 4. 1 by 4 of 36,000 is 9,000. Then 3 by 4 is equal to 27,000. Administration expenses based on time ratio 20,000, 5,000, 15,000. Then rent and rates, time ratio 1 is to 3, 10,800. It is 2,700 to pre-incorporation, 8,100 to post-op. Just division. We'll find out the ratio, find out the 1 by 4, 3 by 4. We'll move on. Director fees direct, 15,000 goes to post-incorporation. Preliminary expenses direct. As per the law, it goes to post-incorporation. Then depreciation, time ratio 18,000. 4,500, 13,500. If you add the figure, the total will come. This is your total expenses. This is your B. Then net profit, A minus B is 55,200. Then pre-incorporation. Here, your total is 24,662. This is your expenditure. Your income is 46,667. A minus B. Your amount come 22,100 pre-incorporation profit. Same here. Out of 1,28,333, deduct 33,199. The difference will come 33,199. It is called revenue profit. This is capital profit. So whatever the profit earned pre-incorporation is called capital profit. Whatever the profit earned in the post-incorporation is called revenue profit. You must know that capital profit transferred to capital reserve, you should not be utilized for distribution of dividend. Revenue profit transferred to statement of profit and loss account, which can be utilized for distribution of dividend. So capital profit transferred to capital reserve, which cannot be utilized, but which can be utilized as a capital, but cannot be utilized for distribution of dividend. Revenue profit transferred to profit and loss account, which can be utilized for distribution of dividend among the shareholders. Hope you understand. This point is most important. If 1 month sale is X, which month are double? April, February, March becomes the 2X. Other things are 1. This is your pre-incorporation period. It is called post-incorporation period. Totally 15 is there. First 3 is called pre-incorporation 4x. Then 11x is there in the ratio 4 is to 11. Hope you understand. Zoom Limited was incorporated on 1st August 2020 to take over the business of Tetra Limited from 1st April 2020. The total annual turnover for the year 31st March was 4 lakh. That is 1,20,000 per period up to 1st August and remaining 2,80,000 for the remaining part. So this is a pre-incorporation sale. It's a post-incorporation sale. Year ending on 31st March 2021, the entire gross profit is given 1,40,000. So salary based on time ratio, general expense based on time ratio, discount allowed based on sale ratio, commission based on sale ratio, rent and rate based on time ratio, interest on loan based on time ratio, director's fees post incorporation, fuel time ratio, carriage outward sales ratio, depreciation time ratio, insurance time ratio, bank charges time ratio, bad debt based on the sales ratio, repair time ratio, your net profit, gross profit based on sales ratio. Calculation. Your date of purchase is 1/4/2020, but date of incorporation is 1st August 1/8/2020. April, May, June, July. How many months? 4 months. From 1/8/2020 to 31 to how many months? 8 months. They are in the ratio of 4:8, 1:2. Then your total sale is 4 lakh, pre-incorporation sale is 1,20,000, post-incorporation period is 2,80,000. Therefore, sales ratio 1,20,000 is 2,80,000. Cancel the 0, divided by 12:28, divided by 4, 4 3s are 4 7s are. So they are in the ratio of 3:7. That is 3/10:7/10. They are in the ratio of 3:7. Gross profit sales ratio 3:7. 3/10 of 1,40,000 is 42,000. Post incorporation is 98,000. Less expense B. This goes to A. Salary time ratio 1:3. Totally how much? 15,600. Pre-incorporation 5,200. Post-incorporation 10,400. General expenses time ratio 1:2. 1/3 of 4,000 is 1,600. 3,200. Discount allowed on the sales ratio 3/10 of 10,000 is 3,000. 7,000. Just division, that's all. Commission on sales, sales ratio 3/10 is 3,000, 7,000. Rent and rates, time ratio 1:2. 1/3 of this is 2,160. You take the calculator and easily divide. Interest on loan, time ratio 2,400, 800, 1,600. Direct fees, direct fuel, time ratio 4,000, 1,660. Divide according to time ratio. Carry order based on the sales ratio 3:7, 6,000, 1,800, 4,200. Depreciation on time ratio 4,500, 1,500, 3,000. Insurance on time ratio totally 1,440, 480, 960. Bank charges and time ratio 840, 280 is 560. Then bad debt based on sales ratio 3:7, 1,200, 360, 840. Then repair on time ratio 2,760, 920 is 1,000. Just a distribution according to ratio. This is your B. Then from the total, if we deduct A minus B, this is your total profit. This is capital profit. This is your revenue profit. You call this as A, total. All this to A. All this to B. This goes to totally B, total. Now, net profit 65,900. In that, capital profit is 19,000. Out of the 65,900, 19,540 goes to capital profit. 46,360 goes to revenue profit. Capital profit can be transferred to capital reserve, whereas the revenue profit transferred to profit and loss account. This profit cannot be utilized for distribution of dividend, whereas the revenue profit can be utilized for distribution of dividend. Just which two ratio is required? One is the time ratio, one is the sales ratio. How it is time ratio? From the beginning date to incorporation, one stay. From incorporation to year ending. So one is pre-incorporation, one is post-incorporation. Up to incorporation is pre-incorporation profit. From incorporation to year ending is called post-incorporation profit. So pre-incorporation profit is called capital profit. Post-incorporation profit is called revenue profit. First, we have to GP, gross profit, should be all the expense goes to the time ratio. Only GP goes to sales ratio, and any expenditure belongs to sale goes to sales ratio. Hope you understand. Very easy, but you must find out the time ratio and the sales ratio. In this session, we have solved the two problems. All the problem based on only time ratio and the sales ratio. All type of problem we already solved. So in the next session, if you have another good problem, we'll come back with another good problem. Till then, goodbye. Meet in the next class with another good problem. Till then, say goodbye. We solved the two problems in this session. Hope you understand.